What's up, Austin? This is Investors. Today, we're talking about Target's earnings. They just reported earnings. They missed on earnings. They beat revenue, but just barely. And then the biggest thing, the issue right now is their guidance and how they're talking about the holiday quarter. And they're saying that they're expecting a very, very soft holiday quarter. As you can see, the stock is down 16% today. And over the last 12 months, shares are down 32%. So we're going to talk about their earnings. We're going to talk about their soft guidance. I'm going to show you the top investors in the world, the hedge funds, the professional investors that own Target stock and how that has increased over time. And then I'm going to get into whether or not I think the stock is overvalued or undervalued right now, in my own opinion. If you don't know me, I'm Austin. None of this is financial advice. I am simply sharing my portfolio here, which I'm trying to build up to $1 million and sharing every step of the way, the wins, the losses transparently. And as you can see, $124,400. We're down $8,600 since February 15th, 2022, when we started this portfolio. I own a bunch of growth style stocks. You can see I talk about my portfolio all the time. For the purpose of this video, I do not own any position in Target Corporation. So here's what happened with the quarter. They reported non-GAAP earnings per share of $1.54 that missed by 64 cents. That's a pretty bad miss, especially since they brought down expectations last quarter. Revenue was $26.5 billion. They beat by $120 million. So right here, this tells me they beat on revenue, but they missed really bad on earnings per share. That means that costs are a bit out of their control, or they had to decrease prices to sell things. And so they got revenue, but it was all at lower prices, lower profitability, which is why there's a huge earnings miss and a revenue beat. That's how that happens with retail stocks. Shares are currently down 14%. Comp sales, which is an important metric for retailers, increased 2.7% on top of 12.7% growth last year. So that's a tough comp, driven by 1.4% traffic growth and 1.3% increase in average ticket. Okay, and what I like to do is dive a little bit deeper into things, right? And so if we go into their actual report, this is the press release. Category performance was led by growth in frequency businesses, including beauty, food, beverage, and household essentials, which offset continued softness in discretionary categories. So what are people spending less on? Things that they don't absolutely need. What are they continuing to spend on or spend more on because of inflation? Things are getting more expensive. The things they have to spend on. Beauty, which you do. I mean, I'm beautiful. You obviously need to stay beautiful, right? Food and beverage, you have to eat. Household essentials. If people are going out less and spending less going out, then they tend to put a little bit of money into like upkeep of their house or whatever. Okay, and here's what the CEO said. In the latter weeks of the quarter, sales and profit trends softened meaningfully, with guests' shopping behavior increasingly impacted by inflation, rising interest rates, and economic uncertainty. This resulted in a third quarter profit performance well below our expectations. Okay, and it's not like they're at risk of like going out of business or anything. It's just a tough business cycle. Operating income was still $1 billion in the third quarter, which is down 49% from $2 billion in 2021. Okay, so it's a tough period for them, but they still have positive operating income. This was talking about having to mark things down. They're able to hit those sales numbers, but not the EPS numbers, right? The gross margin was 24.7% compared to 28%. That's a big drop in a single year. This year's gross margin rate reflected higher markdown rates, like we talked about, inventory shrink, and merchandise and freight costs. Okay, and a big thing that has like helped over the time with the returns for Target shareholders has been the dividend and then share buybacks, right? So the company paid dividends of $497 million in the third quarter compared with $440 million last year, a 20% increase, which is pretty great, right? If you're a dividend income investor. The company did not purchase stock in the third quarter. As of the end of the quarter, they have $9.7 billion of remaining capacity under the repurchase program. So let's take a look and see like what impact that could have on the stock, right? Right here, the market cap is $79 billion. And so they're actually authorized to repurchase 12 or 13% of pretty much all shares outstanding under that authorization. They're not going to do that in a single year or single quarter, but that's a huge authorization and is a significant chunk of the company's entire market cap. So that's actually kind of a good thing to see if you're thinking about this as a position for the long term. All right, so one of the things I'm going to start doing in these videos is covering some of these whale investors or the professional investors, and they do it with like some of the top rated 13Fs. So if we want to just look at hedge funds, right? This then excludes the Vanguards of the world. You've got 8 that have it in the top 10. up from 5. You have 284 that are holding it, down from 310. 23 hedge funds open it as a new position in the last quarter. 123 increase their position, 45 close the position, and 109 reduce their position. So more selling than buying overall. The put call ratio is 1.55, which means that the slant on it is more negative than positive. And if we want to look over the last 5 years, blue line is Target up there. Target is beating the S&P 500. It's up 236%, versus the S&P 500 that's up 69%. Target will be down a little bit once the market opens and this thing actually starts counting today's, but still you can see it is an outperformer over the last 5 years. Again, Target's the blue line here over the last 3 years. It's still outperforming, but then over the last 1 year, you can see the S&P 500 green is down 13% when Target's down 29%, and it's going to get worse today. Since 2001, Target's up 716%. Versus the S&P 500 up 374%. All right, so since Target's a dividend payer, I'm going to jump over to Simply Safe Dividends and just check out some of their dividend metrics. It's got a 2.41% dividend yield. That'll actually go higher because the stock is going lower, which is a little bit higher than its 5-year average. It gets a 90 dividend safety score, meaning their dividend is not at threat of being lowered, at least according to the metrics. They have a low payout ratio and money on the balance sheet to continue paying it. Very good dividend growth, like we talked about, that 20%. A 50-year dividend streak without a reduction. They increased their dividend from 2007 to 2009. Sales were down about 1%, but it was a much smaller company back then, so just remember that. But the stock got crushed from 07 to 09, down 61%. And then just here's a look at their dividend growth, right? 20% was the latest growth. Over the last 5 years, it's averaged 6%. Over the last 20 years, it's averaged 14% per year. Okay, and just from a valuation standpoint, right, is this stock overvalued or undervalued? Well, we see the updated share price is $153, right? This line right here, again, this is like yesterday's close, so it's showing it at 178. This blue line is the average price to earnings ratio it has traded at over the last 10 years. And you can see we're currently above the average PE ratio. And so the stock was showing as a little bit overvalued compared to its historical norm. Since we're down to about 150 a share, that would bring us down to about here, which is much closer to its average PE. But again, because they're lowering their earnings estimates, that it's actually going to raise the PE ratio artificially a little bit. So still, this stock is looking a little bit overvalued in my opinion over the short term. But from 152 a share, which is where we're at right now, over the next 3 years out to January 2025, if it hits a PE ratio of 15, which is actually, again, down from the 19 that it's at right now, and gets the kind of earnings per share growth that's expected, which this is going to come down just based on kind of what we're seeing, but still this is just giving you a frame of reference, right? Then we're looking at a 38% total return, which is 16% annualized, right? So for an investor that's looking for dividend payer, a dividend grower, a solid company that's not going to be gone tomorrow, it actually could be an interesting time to start considering Target stock for investment. But do your own research. This is not an recommendation, and as I talked about, I don't own the stock, so take it all with a grain of salt. Thanks for watching. Best way you can support me for free, like the video, subscribe to the channel, and let me know in the comments if you agree or disagree with my assessment of Target and what stocks you want me to cover. Have a good day.